Hey everybody, it's Justin from Number Crunch Nerds, and in this video we're going to record 5 accounting journal entries, starting with this problem right here, which is on February 1st, 2023, Paulson Company received $40,000 in cash plus equipment with a fair market value of $20,000 in exchange for 5,000 shares of common stock. Prepare the necessary journal entry. All right, so when it comes to recording journal entries, the question always is, well, what did I get and what did I give up? Or what did I get and how did I pay? That's kind of the two ways to ask the question. What did I get and what did I give up? Or what did I pay in order to get that? All right, so let's go through the question here. What did I get? Well, the first thing is I got cash of $40,000. It says right there. So what is cash? Cash is an asset. Asset increases with a debit. So what is the first entry in my journal entry going to be? It's going to be a debit to cash in the amount of $40,000. Okay. Now, what is the second thing I received? Well, it says I received equipment with a fair market value of $20,000. Okay. So when you receive equipment in exchange for ownership in your company, that's what common stock is. Common stock is ownership in your company. You're giving up shares of ownership in your company in exchange for something that you want, in this case, a piece of equipment. So you have agreed with whoever you're involved in this transaction with that you will give them common stock and they will give you $40,000 in cash plus equipment with $20,000 worth of value. So what are you going to do with that equipment? Well, you're going to record it on the books at fair market value of $20,000. Equipment is what? It's an asset. Asset increases with a debit, and so we're going to have another debit for equipment in the amount of $20,000. So we got the debits recorded. I got 2 debits here. This is what I got, $40,000 in cash, $20,000 worth of equipment. Now, what did I give up, or how did I pay to get that? What did I give up? Well, I gave up ownership in my company in the form of common stock. All right, so common stock. There's 5,000 shares here. Should I record a credit over here for 5,000? Well, if I have 5,000 in credits and $60,000 in debits, that's not going to balance, is it? That's not going to be the right answer because the number of shares, the actual quantity of shares, doesn't actually matter. Okay, what does matter? The value of this common stock. And what's the value? Well, the value is whatever you exchanged it for. Okay, you made an agreement with this individual. I will give you a certain number of shares of common stock. It really doesn't matter if it's 1 share, 5 shares, 10 shares, or 5,000 shares. But I'm giving that to you in exchange for $60,000 of value. All right, so that's the value of that common stock. So common stock is an owner's equity account. Equity accounts increase with what? They increase with credits. So I'm going to have a credit to the account common stock, and the amount is going to be $60,000. Okay? So there's my journal entry right there. Debit cash, $40,000. Debit equipment, $20,000. Credit common stock, $60,000. That is my journal entry for that transaction. Let's go to number 2. Paulson Company, on February the 1st, takes out a 2-year 10% note for $25,000 from Bank X. Interest accrues monthly and payments are due on April 1 and October 1 of each year. Prepare the necessary journal entries for February 1, February 28th, March 31st, and April 1st. All right, so it looks like we got 4 journal entries to record here in this problem. Let's take a quick look at the dates because you always got to watch for dates in these kind of accounting problems because dates are going to be what determines what journal entry you're going to record in many cases. Okay, so the actual note was taken out on February the 1st. So it asks for a February 1st journal entry. So what's that going to be? Well, that's going to be just putting the note on the books, right? That's going to be the actual initial transaction of putting the note on the books. Then it's asking for a February 28th transaction and a March 31st transaction and an April 1st transaction. It says in the problem that interest accrues monthly. Okay, so what it's asking for at this date, at the end of this month, February, at the end of this month, March, it's asking you to accrue interest. Accrue the interest on this note. What does it mean to accrue interest? Well, it means to put it on your income statement before you actually pay the cash. That's what it means. It means to put it on your income statement before you actually pay the cash. Because the cash payments, according to this problem, are not due. The first one's not due until April 1st. So if you're going to accrue on February 28th and accrue on March 31st, you are putting it on your income statement, but you haven't paid any cash, right? Because the payment isn't due until April 1st. So April 1st is going to be recording the actual payment, and these two entries here are going to be the accrual of interest, okay? And then February 1 is going to be the when we actually put the note on the books, okay? So step one, before we do anything, step one, calculate the annual interest expense. So what is that going to be? How do you calculate, what is the calculation of the annual interest expense? Well, it's the face value of the note, or the principal, it's called, the principal of the note, which is $25,000. And then we have the rate, 10%. So we got a $25,000 note with a 10% rate. So what's the annual interest expense? Well, it's going to be $25,000 times 10%, $2,500. $2,500 is the annual interest that is due on this note. Now, that's helpful, but it's not actually what we need, because it says here that interest accrues monthly. So after you calculate an annual interest amount, then you need to calculate a monthly amount. So we need to, step two, we need to calculate the monthly interest. And how would you do that? Well, that's pretty straightforward in this problem, right? You would just take the annual number and you would adjust it for a monthly, you make a monthly adjustment, which means divide by 12, right? Divide by 12 months out of the year. So if my annual interest is $2,500, I divide it by 12, I have a monthly interest payment, or monthly interest accrual, as the case may be, of $208. Okay, every month, this I am incurring $208 of interest on this loan. All right, so we've calculated the annual and monthly amounts. Now, what's the next step? Record the journal entries, starting with the February 1st entry, which we said was what? It was actually putting the note on the books. Okay, so what's the question for journal entries that we always ask? Well, it's what did you get? What did you receive? Or what did you give up? What did you receive and what did you give up? Or what did you receive and how did you pay? So what did we receive? Well, we received $25,000 in cash, right? So I think the first entry is going to be what? Debit cash. Cash is an asset. Asset increases with a debit. There it is right there. Cash, $25,000. And what did we give up? Well, we gave up a liability, right? We now have a liability to pay back that $25,000 at some future time, right? So my liabilities are going to go up. It's not like I just got that money for nothing. I owe it, like I have to give it back later. So I'm going to have a credit for $25,000. We know that. And what is the credit going to be to? It's going to be to a liability called what? Notes payable. Liability increases with a credit, right? So there's my note payable right there, $25,000. This is how I record the note to the books. What did I get? Cash. What did I give up? Notes payable. A liability. Liability increases with a credit. Okay, now the February 28th transaction, I need to accrue interest. Okay, I need to accrue interest. I need to accrue, how much interest do I need to accrue? A full month? Well, it says I took out the loan on February 1st. All right, and this is a February 28th entry, which means we're going to accrue 1 month. So we have 1 month of interest calculated right here. What is the journal entry? We know the amount is going to be 208. We know that. What is the journal entry for? How do I accrue interest? Well, I have to put an expense on my income statement. And how do you do that? What is an expense? Income statement account. How does an expense increase? With a debit or credit? With a debit. Expense increases with a debit. So I'm going to have a debit to interest expense in the amount of $208. Now, what's the other side going to be? We know it's going to be $208 because my debits have to match my credit. So I'm going to have a credit over here of $208. What is the account? Well, did I pay it in cash? No. It says right here the cash payments are not due until April the 1st. So I didn't pay it in cash. What do I have? I have a payable, right? I have a payable. I have a liability. I have a liability now, not only to pay back the original $25,000, but I have another liability. I have to pay this interest later because I didn't pay it in cash. So what do I have? I have interest payable. Interest payable is a liability. Liability increases with a credit. So I now have an increase in my interest payable liability of $208. Now, what happens on March the 31st? Well, on March the 31st, another month has gone by, and guess what we're going to do? I hope you guessed that we're going to do the exact same thing. We're going to record another entry to accrue another $208. This is accruing right here. This is what accruing means. It means put it on your income statement, and then because we didn't pay it in cash, we're going to put up a liability again, right? So how much is in this liability right now? How much is in here? Well, it's going to be this number plus this number, right? So that's $416. That's how much is actually sitting in the liability called interest payable after these two entries. So what's the last entry on April 1st? Let's go back up. It says right here, it says the payment is made. The payment is due on April 1. So on April 1, we actually have to pay it. What does that mean to pay it? Well, you pay it in cash. Cash is an asset. Asset goes up with a debit. Asset goes down with what? A credit. Okay, so I'm probably going to have a credit here to cash in the amount of the total amount that's due, which is $416. Okay, so let's take a little sneak peek. There it is right there. $416 is going to be my credit. It's also going to be my debit. We know that because the debits have to match credits. $416 is my amount. And what's my entry? Interest payable. Okay, I'm taking the liability off the books. This is putting the liability on the books. Liability goes up. Liability goes up. Now I paid it. So liability goes down. Liability goes up with a credit, goes down with a debit. This is taking the liability off the books because I'm actually making the cash payment. So liability debit, liability goes down, and cash goes down because cash is an asset. Asset decreases with a credit. So cash goes down because cash went out the door to actually pay off that liability. All right? So that is how you accrue the interest and then pay it afterwards. Okay? So remember, let's just do a little summary here. What does it mean to accrue interest? It means to recognize the interest expense on your income statement even though no cash has been paid. Okay? Remember, this is accrual accounting. What we're learning here is accrual accounting. So under the US GAAP or IFRS, which stands for International Financial Reporting Standards, we have to recognize expense, which means to put it on the income statement, as it's incurred, not necessarily how the cash moves. Okay, that's what accrual accounting is. It is recording expenses and revenue on your income statement when they are earned or incurred, not necessarily when the cash moves. So that is five accounting journal entries recorded under the fundamental accounting equation under accrual accounting, which is the acceptable accounting method in the United States as well as in most of the rest of the world.